My name is Paul, and welcome to month 2 of my Wealthsimple $100 per month Canadian stock portfolio. And before I actually get into things, I do want to mention right off the bat that I was wrong last month about the number of stocks that Wealthsimple offers fractional shares on. I don't know why they decided not to edit their page and remove the part where it says that they only offer these 4 companies, but they have a different updated article showing that they actually do have a ton of different companies that I didn't know about because I saw the original article where it says that you can only get access to Canadian National Railroad, TD, Royal Bank, and Shopify. If I had known that I had access to this updated list, I definitely wouldn't have kept $2.20 sitting in cash in the portfolio. So that means that I will be adding an additional stock that I can buy fractional shares of to the portfolio this month. But before we get into any of that and how the portfolio performed, I'm just going to quickly go over the goals and rules for anyone who might be new to this series. If you want to skip ahead to the portfolio's performance or the analysis of the stock that I'll be buying, feel free to skip ahead using the timestamp on screen or the chapters in the video description below. We have a lot to get to this month, so I'm going to try and get through this part pretty quickly. So the first rule is with this portfolio, I add $100 every month. I can't add more, I can't add less. Next is that all trades have to be placed on a single day each month if I do decide to buy or sell any shares. Third is that only securities trading on Canadian exchanges can be purchased in the portfolio, derivatives are off limits within the portfolio, and no companies with a market cap over $300 million can be bought or sold within the account. My reason for implementing these rules is to try and emulate the circumstances that I believe are limiting to a lot of Canadians, and to show that if you save up and invest over a long period of time, even with just a little bit each month, you can really achieve a lot of your financial goals that might seem impossible now, especially if you get started early on. Also, I have a personal goal within the portfolio, which is to achieve a 12% compounded annual rate of return or more. That's just because I put a lot of time and effort into doing research into different businesses, and I believe that over time, this outperformance, or rather this level of outperformance, should make the research that I do worth it. If you want to see the portfolio rules and goals in more detail, there is a link in the description to a full document that has all of that information. But now that we've got the rules out of the way, I'm just going to quickly give a recap of the companies that are held in the portfolio. The first security is the Morguard North American Residential REIT, ticker symbol MRG.UN on the Toronto Stock Exchange. Again, there are 3 different Morguards traded on the TSX, so make sure you're looking at the right one. It should be the North American Residential REIT with the ticker symbol MRG. And what Morguard does is it rents out units for people to live in within the US and Canada. Last month, I invested just over 70% of the portfolio's first $100 into Morguard, and this was proportionally a very large investment that was made because I believe that the business is trading at a massive discount based on the tangible book value of its assets and when comparing it to its peers in both the Canadian and US markets. On top of that, I believe that its average monthly rent per unit and the property value of its real estate are both set to see steady increases because of the management's focus on acquiring units in areas that are expected to see above average population growth over the next few decades. The second company that was bought in the portfolio was Knight Therapeutics, ticker symbol GUD on the Toronto Stock Exchange. Knight is a pharmaceutical company that is based in Canada but operates mostly in Latin America through licensing, marketing, and distributing generic and innovative drugs. Last month, I invested a bit over 25% of the portfolio's first $100 into Knight, and this was proportionally smaller of an investment than Morguard, just because I believe Knight's discount isn't quite as certain or as large, and in the case where it turns out I'm wrong in my hypothesis, the choppy cash flows from unstable Latin American currencies would likely take a little bit more time to recoup the money I invested. That having been said, I do believe Knight Therapeutics has a much larger potential reward that comes from its loans to biopharmaceutical companies, which include product rights, should borrowing companies develop a successful product. In addition to that, the management team has had previous success with the exact same conservative business model in the United States, under the Paladin Labs banner, and they have a proven track record of making high-quality acquisitions that can be grown out. The stock is also trading about 30% below what I believe the fair value should be on the business, based on the historic tangible book value per share. And when you consider that the company operates with almost no debt and has a giant cash pile, I think that the risk is relatively low for a reward that could be pretty nice should they get the exclusive rights to a high quality drug. But even in the instance where that doesn't pan out and the stock only reverts to what I would consider to be fair value on the business today, there would still be a nice upside of about 30%. So that was my quick summary. If you want more in-depth detail on some of the reasoning behind these two stocks, then I'd recommend going back and watching the first month's video where I talk about everything much more in depth. And that'll be linked in the description and probably as like an end scene at the end of the video. Moving on, let's take a look at how these two companies performed. And just know that this part of the video is being recorded on Thursday night after market close. So if the stocks don't match up with the current price, that's why. Okay, so first we're going to take a look at Morguard, which announced shortly before I made my last video that they would be doing a normal course issuer bid that allows them to repurchase and cancel up to 5% of the company's public float. After this announcement, it wasn't too surprising that the REIT decided not to raise their dividend, which for me is completely fine. I think shares are currently undervalued, so I'm happy that the management decided to postpone paying a larger dividend and will be focusing instead on repurchasing some of the REIT units. The reason I like this repurchase is just because it means I'll own a larger percentage of the business without having to pay an additional tax on what would otherwise be a larger distribution. Not that you'd have to worry about that if this were in your TFSA, but this is a mock TFSA, so I'd still have to pay real life taxes on it. That having been said, I do have a small issue with this in that Morguard already has an active normal course issuer bid, but hasn't really taken advantage of any of the cheap share prices since they've bought none of the units, though I guess they could have, and it'll come to light in this quarter once they announce earnings, but still, I don't think it makes more sense to be buying now than it did then. However, if they do decide to buy now, I'm still happy with it because it is discounted. It's just a question of why didn't you buy more before when it was even cheaper? So I guess we'll just have to wait and see what happens. But also worth mentioning is that we did pass our first ex-dividend date and should be receiving a whopping 23-ish cent payout from Morguard on the 15th of February, which is nice. It's our first dividend payout, and Morguard does pay a monthly distribution. So you can expect to be hearing about these distributions every month going forward for the foreseeable future, unless something bad happens. As for the performance of Morguard's shares, it was a bit of a rocky month, with prices dipping well below the $17.85 price that I bought it at, all the way down to $16.22 at one point, before finally recovering and actually exceeding our book price, ending up at $18.48. So an exciting bit of action for anyone who likes reading tape, but to be honest, I barely even noticed the dip, and kind of just wish it lasted a bit longer so that I could take advantage of an even bigger discount in this portfolio. But still, I plan on buying more shares tomorrow when the markets do open, which you'll see in a few minutes. That's about all for Morguard, so next up is Knight Therapeutics, which had a much different month. Despite overall market volatility, Knight's share price was pretty resilient and almost never dipped below the buy price of $5.28 and managed to end the month up at $5.51. This price wasn't really caused by anything that I'm aware of since Knight's business didn't report anything new going on, so let's move on to how the overall portfolio performed, which, considering the two stocks both had an upward month and the market didn't do too great, we did pretty all right. So the portfolio's positions were up a decent amount over the past month. Morguard increased by about 3.5%, and Knight performed even better, increasing by over 4.3%. Then, of course, there was the $2.20 that was left over in the account, which is still sitting there waiting to be invested. Overall this month, the portfolio increased in price by 3.67%, which comes out to exactly a $3.67 increase as of market close on Thursday, February the 3rd. 3.67% in the first month is way ahead of my 12% annual goal. So I'm glad things are off to a good start, but I don't really expect these kinds of results that are this strong to continue over the long run, as nice as it would be for that to happen. More importantly than pure percentage-based returns, though, let's take a look at how that $100 would have performed if I instead decided to buy a few different ETFs. And of course, I'm going to be assuming that I can only buy fractional shares of ETFs that have fractional shares offered by Wealthsimple. The ETFs that I chose are all Vanguard branded ETFs that trade on the TSX, but I'm open to changing or adding a couple of different ETFs if there's demand for it. So I guess just post a suggestion in the comments, and if there's any interest in a specific ETF, then I'll add it to the group. So Firstly, there was the US Market Standard S&P 500 Index ETF, ticker symbol VFV on the Toronto Stock Exchange, which is actually the only ETF that I'm comparing against that has fractional shares available on Wealthsimple. And if I had bought $99.99 in fractional shares of VFV at around the lowest price between when I bought Morguard and Knight stock on January 7th, I would have had 0.9522 shares of the ETF and 1 cent left over. And by the end of the month, this would have decreased by about $4.02, making it the worst performer of all of the mock ETF portfolios, underperforming the actual monthly portfolio by nearly 7.5%. The best performing ETF portfolio that I tracked over the month was the Canadian Large Cap ETF, ticker symbol VCE. Using $100, I would have been able to buy 2 shares for $46.04 each, for a total cost of $92.08, with $7.92 left over. By the end of the month, VCE increased by 17 cents per share, leading to a total portfolio gain of 34 cents or 0.34%. Once again, underperforming the real portfolio by about 3.21%. The other 2 ETFs that I tracked were the Canadian All Cap ETF, ticker symbol VCN, and the Global Value ETF, ticker symbol VVL, both of which also underperformed the public portfolio by 3.39% and 5.08% respectively. So the portfolio is off to an early lead, but it'll fall behind if I don't get to investing this month's $100. So let's get into this month's additions to the portfolio. All right, now I mentioned at the start of the video that I'd be adding a new stock to the portfolio since I have a much larger selection of companies with fractional shares to choose from on Wealthsimple than I'd originally realized. But before I get into which company this is, I'll also be adjusting my capital allocation, since I believe this company is almost as good an investment as Knight Therapeutics. But without fractional shares, I wouldn't be able to buy into this company without compromising my capital allocation into Morguard, which I still believe is the best investment on the Canadian markets. Still, I think this company does deserve a larger position in the portfolio than just a placeholder for the loose change that's left over at the end of the month. So I have to decide whether I should invest less money into Morguard, which would have otherwise taken up 70% of my monthly contribution, or Knight, which would have made up over 25% of my monthly contribution. For me, this decision was pretty easy to make. I decided to limit my investment into Knight this month down to 2 shares, or about 11 of the $100. And this is because Morguard is my top idea, and everything that I've seen indicates that it is cheaper and is almost certain to give me a good return over the long run. Now, Knight is still cheap, but there are some risks apparent to me with the company that are not present in the Morguard North American Residential REIT. And I'm not going to try and be overly greedy by investing more money into something that I have less conviction in just because it has the potential to be a really big winner. So let's go ahead and buy our 4 shares of Morguard and 2 shares of Knight and see what we have left over for our new stock. Let's see. So we're going to buy 4 shares of Morguard. Market price should be fine. It looks like it's going for about $18.57 now. So our estimated cost is going to be about $74.28. Let's go ahead and buy that. Confirm. All right, and it looks like we got it for an average looks like we got it for an average of $18.55. So not too bad. We spent about $74.20. So if we go to our portfolio, we should have $28 left to trade after we buy our 2 shares of Knight Therapeutics, which look like they're going for $5.52. We should have about $19-ish left. So let's go ahead and see, make that buy, next, continue, confirm, and done. We spent $11.04. And if we go to this, we can see that we got 2 shares for $5.54 a piece. And both these trades happened at 11:57 a.m. and we will see how much we have left over in the account. We have about $17 left over to spend on the next stock. Okay, so it looks like we have $16.92 left over to invest into what will be the portfolio's newest addition. And that stock is MTY Food Group, ticker symbol MTY on the Toronto Stock Exchange. MTY is a company that franchises and operates fast food and casual restaurants, mostly in Canada and the United States, and they own a lot of different brands and restaurant types, ranging from larger fast food and casual dining chains to smaller one-off restaurants and food stalls. And when I say that they have a lot of different brands under their banner, I mean that they have over 80 different restaurant brands covering pretty much every cuisine that you could possibly imagine. Some of their larger chains that you'd probably recognize are Baja Fresh, Taco Time, Yuzu Sushi, Sweet Frog, Mucho Burrito, Papa Murphy's, and Cold Stone Creamery. Now, I'll go ahead and address the elephant in the room here. None of MTY's restaurants are the most widely known or the best brands in their given food categories. Cold Stone falls up short behind Dairy Queen and Baskin Robbins. Taco Time has nowhere near the brand recognition of Taco Bell, and Papa Murphy's probably isn't even in the top 5 chains that come to mind when you're thinking of pizza. Put simply, buying MTY stock isn't the same as buying McDonald's, Yum Brands, Restaurant Brands International, or any of the other big chains that everybody knows about. But that's part of what makes MTY such a good investment. Unlike their larger competitors, you don't have to pay an expensive premium on earnings. McDonald's, Yum, and Restaurant Brands International all trade at earnings multiples in the mid-20s. Meanwhile, MTY is currently sitting at a PE of under 17. And if we go ahead and take a look at how these companies have each grown their earnings over the past 15 or so years, excluding years where they were affected by the pandemic, you'll find that Yum Brands performed the worst, increasing earnings by only 3.2 times over the period. They were then followed by McDonald's, which grew earnings by almost 4 times, and then Restaurant Brands International, which did the best over this time period, growing by about 5 times. Now, if we compare them to MTY, you might be surprised to find that MTY more than 12x'd their earnings per share growth over the same period. So it appears like there's a big discount on a company that's growing way faster than its competitors, which is nice. But a lot of this growth can be chalked up to the insane acquisition history of the company, who acquired an average of 2 different restaurant brands per year for 20 years straight. And these acquisitions over the past 20 years include every single one of MTY's current top performing brands. So clearly something special has to be happening here. A company doesn't just accidentally acquire a bunch of brands that outperform industry giants, all of whom have more capital than them and would be perfectly capable of making these exact same acquisitions. For instance, over the same time period, the fastest grower of the larger restaurant chains, Restaurant Brands International, which at the time was just Burger King, merged with Tim Hortons and bought out Popeyes. Still, their growth rate was less than half of MTY's. So again, something's happening here. And after doing a lot of thinking, I'm of the opinion that the reason that these other companies don't acquire the sorts of businesses that MTY strategically targets is because brands like Mr. Sub are the places that people go to eat on their lunch break when the food court doesn't have a Subway and the people don't want to pay more for Quiznos. With Mr. Sub, the menu items rarely change, and the brand doesn't try and announce itself as anything other than a place to go and get a sandwich when you're hungry. On the other hand, McDonald's is a place for family, and then it's a cafe. Subway is making crispy chicken sliders and soups and breakfasts. Domino's has changed their entire pizza recipe, and I'm like 99% sure that KFC did the exact same thing with their secret blend of 7 herbs and spices, but didn't tell anyone. The point of all this is that there's an expensive process involved in reworking a brand so that it constantly reaches the most possible people. Whereas MTY is perfectly happy buying out niche brands that are making money and satisfying the niche food demands of their customers. And instead of spending extra money rebranding their burger shops into, say, coffee shops, they'd rather let their burgers keep selling the way they always have been and use the money to buy out a decent coffee shop brand that's free cash flow positive, then add more locations. When I'm looking to buy into a company, having the number 1 brand is definitely a huge bonus. But if the number 4 brand will make me the most money because they don't have to make the same expenditures to maintain that top spot, well, I'm going where the money is. And MTY's focus on finding these money-making companies lines up exactly with what I'm trying to do as an investor. So it shouldn't come as too much of a surprise that insiders make up almost 20% of the company's ownership, with the founder and former CEO and current executive chairman of the board, Stanley Ma, holding the vast majority of these shares himself. Much like Kudlip Rai Sahi of Morguard and Jonathan Ross Goodman of Knight Therapeutics, I believe that Stanley Ma is a superstar to have on board, and he's almost certainly the biggest contributor to MTY's success. In 1979, Stanley Ma only had one single restaurant, and over the period of 40 or so years, he grew MTY into a $1.3 billion empire that's growing earnings faster than any of its competitors, including Starbucks and Domino's, which are some of the fastest growers in the industry. So those are the good side of things. Now let's get into the two negative points that are keeping MTY from becoming a much larger investment in the monthly portfolio. And the first issue is that the company, much like the rest of the restaurant industry, was hit very hard by the pandemic and following regulations. And while it is starting to look like we're coming out on the other side of things, MTY definitely isn't in as safe a position as Morguard or Knight in terms of operating a needs-based business. If there were some sort of recession or other pandemic-like event, people need to pay their rent and buy their medication. But if money starts getting tight, eating out at a restaurant is probably the kind of discretionary spending that's going to get cut down on. And this danger during times of hardship definitely isn't helped by the second negative, which is the company's debt load. See, MTY's aggressive acquisition strategy is heavily funded through the use of leverage. The company regularly operates with more current liabilities than current assets and has a pretty substantial negative tangible book value per share. And even though some of the intangible assets, mostly pertaining to brands and trademarks, have some real value, the company is still very indebted. And I think that it's definitely something that needs to be taken into account if you're considering investing in the company, especially considering how the COVID shutdowns caused the company to temporarily close nearly 15% of their stores and suspend the dividend for about a year and a half. And I definitely don't think that those concerns should be understated, though these issues are lightened a bit due to the company's operations, which are very light on capital expenditures, and that in large part allows the business to have a strong net margin of around 15%. And that has actually allowed the company to start being able to pay off some of this debt without having to dilute shareholders, despite all of the extra debt-related risks that the company faced throughout the lockdowns. Honestly, the company's ability to recover is probably one of the top reasons that I'm willing to even consider investing in it at all, because not only have they been able to remove 20% off of the total liabilities in the balance sheet over the past 7 or so quarters, but they've done this while reinstating and then raising the dividend to the highest level it's ever been at, which is pretty impressive, especially when considering the sub 20% payout ratio. Now, I've already talked a lot about all the great things that this company has done in the past, but for me as an investor who's looking to buy into an individual company, I also want and almost need there to be some way for the company to achieve more organic growth going forward without having to rely on acquisitions that aren't guaranteed to be there in the future. This company obviously does have that, otherwise I wouldn't be talking about it here, and I think this comes in a few different ways. The first being expansion of successful brands into additional markets. The second way is going to come from selling packaged food products in retail stores that are staples of some of their more popular brands. Every time that I go to Costco, I always see the Taco Time quesadillas in the freezer section, and they must be selling well because a week or so ago, I went in and the Sunrise Farms broccoli and cheddar chicken cutlets that I usually buy are no longer being sold in stores, and the quesadillas were still there and doing pretty well, it looked like. Anyway, this isn't just an added avenue of growth for the company. It more importantly has the potential to become a stabilizer during tough times when people might choose to eat out less. So I think it's definitely a good thing that the company is continuing to build their retail presence. Though I do wish that they'd put a link on their site to a list of their products, because I couldn't find any mention of them on the MTY Food Group website, nor in their financial reports or presentations, or anywhere else online for that matter. And I know they exist because I've seen at least one of these products in person, and their financial reports do mention that they have well over 100 products selling in retail markets. So I sent them an email asking for a list of their products and where they can be purchased, so maybe next month I'll have an exclusive sneak peek into a $1 billion plus company. Or maybe I'll just get an automated response. Either way, I'll keep you guys posted. And the final growth prospect stems from MTY's variety of unique restaurants, which I believe will experience increased sales thanks to the growing use of meal delivery apps, specifically Uber Pass, which bundles ride perks, fee-free grocery delivery, and most importantly to MTY, fee-free meal delivery and an additional 5% savings on restaurant orders. Now, I'm not here to talk up US companies, but I think that these discounts will encourage a lot more people who use one or more of these services to subscribe to the app. And once subscribed to the app, they'll be even more likely to eat out more frequently in order to feel like they're getting that full value out of the service that they're already paying for. I also know from experience that there are a good number of people who, when ordering food, like to try out a bunch of different restaurants and cuisines, which I think will be very beneficial to a company like MTY, who has over 80 different brands under their banner that offer an array of different culinary experiences. But at the risk of sounding like I'm trying to sell you on this stock, I'm going to cut it here with the future growth potential stuff, since none of those scenarios are guaranteed to play out. It's just something that I think could happen and would be good for the stock if it did. The main reason behind my investment into MTY, though, is just because it has a strong history of EPS growth, it's trading at a discount to its slower growing peers, it's found a way to be resilient during times of hardship, and it has a top tier executive board member who founded the company and who's been guiding successful acquisitions for a very long time. So with all that out of the way, let's get back onto Wealthsimple and buy the stock with the remaining money that we have left over. All right, so I've set up an order to buy $16.92 of fractional shares. So let's buy our MTY shares. We're going to get about 0.306 shares for an estimated cost of $16.92. Confirm the order, and we're done. And it said that it should come in by the end of the day. So I'll check back with you when everything is in, and I can give you an update on how the portfolio looks after everything has cleared, because this trade is still pending and is probably going to continue to be pending until either the end of the day or maybe even on the weekend. I'm not sure. All right, so it's been a few hours and I just got an email saying that the fractional share order of MTY was filled, and it looks like I got 0.3073 shares with the $16.92 for a price point of $55.06 per share. Okay, and again, I'm coming to you from the future, and I took a little bit of time to update this spreadsheet so that way we have a better visual representation of what the portfolio currently looks like and how I use the portfolio's capital this month. So as of market close on Friday the 4th, I have $148.64 in Morguard, which makes up 72.7% of the portfolio. I have $38.85 in Knight Therapeutics, making up 19% of the portfolio. And I have $16.96 worth of MTY Food Group, making up the remaining 8.3% of the portfolio. On top of that, I've successfully deployed all of the portfolio's cash into companies that I'm happy to be invested in. Also, you probably noticed that the book cost and unrealized net gains were adjusted, and this had to be done just because Wealthsimple doesn't show the value of additional decimal places for cash amounts. So, for example, if I were buying shares of Knight for, say, $5.35 and 1/3 of a cent each, that 1/3 of a cent would be rounded down when displayed on Wealthsimple. So when I went ahead and added up my book cost for all of my shares, I noticed that it was off by a few pennies. And after searching around, they're still shown in the portfolio's value. They're just being rounded down to the nearest cent when we look at the individual orders. And since book cost is part of the formula I use to achieve the net unrealized gain, it also had to be adjusted. So that's kind of annoying, but this shouldn't really impact too much of anything, but I just thought it was worth mentioning. And with that said, I think that's all that I wanted to cover for this month's update. So as always, remember, I consider the information that I present in these videos to be a good jumping off point for you to do further research into companies that sound appealing, because this presentation in no way covers everything that should be looked at when valuing a company. I'm only summarizing the reasons behind my decisions to buy the companies that are mentioned in these videos. I'm not a financial advisor. I'm just a Canadian who likes investing and sharing my opinions with others on the internet. So I hope you found some value in this video. If you did, please consider sharing it with someone else who you think might also benefit from seeing it. Thanks for watching and enjoy the rest of your day. And hopefully this time the video doesn't get cut off.